Most Americans don't realize that the country's largest source of imported oil isn't the Middle East. It's Canada, a country that supplies over half of U.S. crude imports through pipelines and cross-border energy networks. And decisions being made in Ottawa right now could affect U.S. gas prices, refineries, and national energy strategy. Over the past decade, Canada has become the United States' most important external supplier of crude oil. In recent years, more than half of America's imported crude has come from Canadian sources. Distance pipelines connect Alberta and Saskatchewan production regions to U.S. refineries in the Midwest and Gulf Coast. This integration helps shape gasoline prices, winter heating costs, and the broader strategic landscape of North American energy relationship has been stable. New policy debates in Ottawa are prompting analysts to reevaluate the future. Canada's federal government has introduced a series of climate-focused regulatory proposals targeting emissions from the oil and gas sector. These proposals include sector-wide emissions caps, carbon pricing mechanisms,
and expanded reporting requirements for heavy-emitting industries.
Supporters say these measures are essential for meeting long-term environmental commitments and climate targets. Critics argue the combined effects could restrict production growth and reduce competitiveness against other global suppliers.
For the United States, this energy relationship matters for several key reasons. And U.S. refineries are configured to process heavy sour crude, the type produced in large volumes in Western Canada. Decades of capital investment have been built around that specific feedstock, making Canada a critical supplier. U.S. energy planners view Canada as a stable, democratic partner in a market often shaped by geopolitical risk. Third, consumer prices in the U.S. remain highly sensitive to supply shifts, especially in regions reliant on cross-border. Canadian industry groups warn that an aggressive emissions cap system could force producers to reduce output. Economic modeling from multiple Canadian institutions indicates that steep emissions reductions achieved through production cuts could affect GDP and employment. Export revenue could also be impacted, given Canada's role as America's primary supplier of heavy crude. The concern isn't just the policy itself, but regulatory uncertainty, as companies hesitate to invest without long-term clarity. Energy firms say that when regulatory frameworks are uncertain, multi-billion-dollar projects are delayed or scaled back. International market dynamics add another layer of complexity to the North American energy picture. Venezuela has some of the largest overall oil reserves in the world, much of it in very heavy crude grades used by U.S. refineries. Historical declines in Venezuelan production stem from sanctions, underinvestment, and infrastructure challenges. Analysts say if Venezuela were to regain access to capital and technology, oil output could slowly recover over time. In that case, Canadian producers might face renewed competition for heavy crude refinery capacity, driven by pricing, transport costs, and crude quality differences. The U.S.-Canada energy relationship extends well beyond crude oil. Canada is the dominant foreign supplier of natural gas to the United States. It is also a major exporter of electricity to U.S. markets in the Northeast. The value of bilateral energy trade often exceeds $100 billion per year. Any disruption, regulatory, geopolitical, or infrastructural, would impact sectors like transportation, manufacturing, and agriculture. Market observers note that energy markets strongly dislike uncertainty. Today, uncertainty is coming from several directions at once. There are climate policy transitions, legal disputes over regulatory authority, possible changes in global supply, and questions about refining capacity. When several risk factors align, companies slow major investments, hedging increases, and prices become more volatile. It's a familiar pattern. Less certainty in policy and supply often leads to greater uncertainty in pricing. For American consumers, this topic often feels abstract until it reaches household budgets. When crude prices change, those shifts eventually show up at the gas pump through gasoline and diesel costs. In colder states, natural gas markets influence winter heating bills, which can rise sharply during peak demand. And for businesses with transportation fleets, even small fuel price increases become significant operating expenses over a year. It's a reminder that energy policy and market volatility don't stay on spreadsheets. They land in. From a strategic perspective, U.S. energy planners have long viewed Canada as a dependable
partner in an unpredictable global market.
Maintaining that relationship requires policy alignment on both sides of the border. In Canada, policymakers are balancing climate objectives with industrial competitiveness. In the United States, officials must weigh refinery needs, market access, and broader geopolitical priorities. If Canada maintains stable output and regulatory clarity, North America keeps a major energy advantage. But if production declines or uncertainty continues, the U.S. may look elsewhere for supply. That shift could alter the geopolitical calculus, depending on which regions fill the gap.
The key point is simple. North American energy security is deeply interconnected. Decisions made in Ottawa today will influence economic outcomes in Detroit, Chicago, Boston, and beyond.
To anticipate what comes next, we need to understand policy mechanisms, infrastructure limits, and market forces.
And that complexity explains why analysts are watching this moment so closely. That's the latest on North America's energy dynamics. We'll update as conditions evolve.
Thanks for watching. Stay informed, stay analytical. Energy, economics, and geopolitics rarely move on separate tracks. In this case, the link between Ottawa and U.S. markets is clearer than many assume. We'll continue to provide measured, factual updates as the situation develops.